Great.
All right, so folks, we're about to get to our last presenter for the day, our last presentation, and that would be from Dr. Kevin Gillen from Drexel University. As you know, he has been with us many, many times before, and we always look forward to hearing his analysis of what's going on in the market, both in the rearview mirror and then what he's seeing out of the front windshield. So we are so grateful to have him here with us today to give his latest report. If you bear with me for one moment, I will get that slide deck up. So with that, Kevin, good morning. We're so grateful to have worked through those technical challenges, and now we have the audio all fixed. And also too, thank you to all of you for your patience with us working through those little challenges. So let's see. Boom, there we go.
All right. All right, well, thank you very much, Matt. Again, apologies for the minor technical difficulties, but I'm glad we got it cleared up. Again, always a pleasure to be here with GPAR at your annual meeting, and always an honor and a pleasure to present to you. So without any further ado, Matt, we can just jump into it here. So we'll talk today about the outlook for Philadelphia's housing market. The first half of the presentation is just going to be on the market itself, sort of where we are in the cycle, what things are doing, what they're looking like, etc. And then on the second half, we'll actually be looking at something more structural on basically what the effect of COVID has been on our region's patterns of household migration. So first of all, we'll start with the big, 30,000 feet economic overview of the economy locally. So first of all, we'll talk about unemployment in the region. Unemployment is down from its COVID peak. The red line is the unemployment rate in Philadelphia. The green line is the unemployment rate in the Philadelphia suburbs. It includes the Pennsylvania counties as well as South Jersey and Newcastle County, Delaware. And then the blue line is the national unemployment average. As you can see, historically, Philadelphia's unemployment tends to be higher than both the suburbs and then the nation as a whole. You can see the big spike on the right is the spike in unemployment during COVID. As you can see, that's down dramatically. Thankfully, most of the jobs that we've recovered since the big lockdown of in spring of 2020 are the jobs you want to recover. They're generally high-paying professional jobs. These are people who can work from home. They primarily work in front of a computer, or they can conference via Zoom. The jobs that we're still trying to recover are the what we call lower paying service sector jobs, particularly retail, restaurants, and hospitality. But as you can see, Philadelphia's unemployment rate is still relatively high, even though it's down from its COVID peak. It's about at the same level as it was roughly 10 years ago during the Great Recession. So we still have some progress to make on that. But again, we've come a long ways from where we were, say 18 months ago. Next. Population growth. So one of the key drivers of the housing market, as you well know, is population growth. Population and income growth are the two main drivers on the demand side. Here I'm comparing resident population in Philadelphia to Philadelphia's suburbs going back to 1970. As you can see, the city generally has a significantly lower level of population than the suburbs. About 2/3 of the region's population resides in our suburbs, although we are the most populated county in the region. But as you can see, it's sort of like a trend here of like a pair of scissor blades. They're going in the opposite direction, so we don't want that. Our suburbs have generally been growing in population for the past 50 years or so, whereas the city has generally been declining. We have made some progress in the last 8 years. We actually just gained modestly in population, so we're not declining anymore. But again, you want to track your demographic trends on the demand side if you're going to track housing. So we would like to see our population growth doing a bit better. Next. Again, the other big demand side driver of housing is household income. So here again, I show compare median household income in the region going back to 1989. Again, the red line is Philadelphia County, the green line is Philadelphia suburbs, and the blue line is the U.S. Again, as you can see, the city is a much lower level of income than both the national average or the suburbs. Roughly, our household income is about $47,000 per year, which is about half of what it is in the suburbs. It's over $80,000 in our suburbs. And again, also below the U.S. average. As we well know, we are the poorest big city in America. Of the large U.S. cities, we have the highest poverty rate of any of them. About 25% of our population is in poverty. So you can see we have experienced some income growth since COVID. We've seen a sharp uptick. If you look at that red line all the way on the right. But again, we still lag both the country and our suburbs. Next. Here's not only is our income level, household income level lower, but also our growth rate of income over time is also lower. So this chart compares the annual percent change in median household income roughly over the last 20 years. Philadelphia being the red bar, the suburbs being the green bar, and the U.S. average being the blue bar. As you can see, our annual change in median household income is about 2.5%. We actually have outpaced the suburbs during that time, even though our household income level is lower, but we still lag the national average, where nationally household income nationally grows at roughly 2.7% per year, whereas we're growing at 2.56%. They may not seem like a big difference, but remember, when you take in the fact of compounding interest over time, over 10, 20, 30 years, that can result in real disparities. Next. As you know, interest rates remain near historic lows, so that's not really one of our big concerns right now. That certainly helps supporting the market. I believe that President Biden's renomination of Jerome Powell to the Fed is a sign that he's going to remain relatively hawkish on inflation. They want interest rates to remain low, but he did not appoint a dove. So I think that's some good news there. But again, you know, in the intermediate run, we're going to see interest rates going to have to start coming back up, especially with inflation being where it is being pervasive in the economy right now and growing as well. Next. So that's on the demand side. On the supply side of housing, the two things you want to look at are construction costs and land availability. That's what drives the supply of housing. Those are the supply side factors. We generally don't have a problem with land availability in Philadelphia with a lot of vacant land, maybe not necessarily in the most affluent parts of the city, but it does exist. But we do have a construction cost issue. Our construction costs in our region are well above the national average. I couldn't get the numbers for just Philadelphia County versus the suburbs, but I could get it at the state level. And this shows the average hourly wage in the construction industry over time. So the blue line is New Jersey, the orange line is Pennsylvania, and then the dark blue line is the US average. Now, we may be in Pennsylvania, but our construction costs are much more in line with what they are in New Jersey, which you can see is well above the national average. Average hourly wage in construction in New Jersey is about $42 an hour. If anything, I think that's on the low side. That's got to be for just general labor. I know in the skilled trades, you know, master carpenters, plumbers, sheet metal workers, I mean, they can make $70, $80, even $90 an hour. And our construction costs are much more in line, I think, with that range than they are with the rest of the Commonwealth of Pennsylvania. So what that does is that it drives development towards the higher end of the market. It makes the building of affordable housing or low moderate income housing very difficult because that cost of construction drives up the overall cost of development, so that it skews doing development towards the higher end of the market. So you may have heard that, you know, a lot of people complain that the 10-year tax abatement is what's causing, all our new construction to be high-end construction, but more fundamentally, it's our generally high cost of development. Next. All right, so that's the general economic overlook. Now let's jump into the actual numbers for the housing market. So we'll start with house prices. So since COVID has hit, house prices have risen dramatically, both locally and nationally. This chart shows the median price of single-family homes in the region and in the country going back to 2000. Again, the red line is Philadelphia County, the green line is Philadelphia suburbs, and the blue line is the US. You can see the big hump in the middle of the chart. That's the housing bubble and then the Great Recession. We hit bottom both locally and nationally in about 2012. That's when the current expansionary cycle began. And house prices have been growing ever since, but they've grown at an accelerated rate since COVID hit. They're up 20% in just under 2 years, okay? In less than 24 months, house prices are up 20% in the city. So if you consider that's roughly a 10% rate of return, the annual rate of return on the purchase of a Philadelphia home compared to how low interest rates are, that's a very good return on investment. So in one sense, that's good. We've got a robust growth in house prices. On the other hand, when house prices grow faster than incomes, you run into an affordability problem. And I'll talk about that. I have some slides on that later. But bottom line, prices are up, and they've been up strongly over the last roughly 2 years since COVID hit. Next. So, but in terms of the level of house prices, Philadelphia generally lags its suburbs. So here I'm showing the median price of single family homes, same thing as the last chart, but now I'm breaking it out by counties across the region. So again, the red bar and the red line is Philadelphia County. The blue lines are the Pennsylvania counties, and the green lines are the New Jersey counties, and the purple line is Newcastle County, Delaware. So even though we've had significant house price growth here in Philadelphia, we still are one of the lowest priced markets in the entire region. Only Salem County, New Jersey is lower priced than us. Our median price right now is about $220,000. Salem County is about $201,000. But Salem County is generally a low income, very rural county. You can see we're especially well below the Pennsylvania suburban counties of Montgomery, Bucks, and Chester in particular, where median prices are over $400,000. The median house price per square foot, if we break it out by that, of course, the suburbs have larger homes, that generally speaking, than the city. But even if you control for that, we are still among the lowest priced markets in the region. Average house price per square foot, median house price per square foot in Philadelphia is about $163. By contrast, Mercer County, New Jersey, which contains Princeton, is $214 a foot. Bucks County, $217 a foot. Montgomery County and Chester County are about $207 a foot. So again, even with our growth, we still remain very low priced, at least compared to our peers across the region. Next. But during the current expansionary cycle, we've actually been outpacing the suburbs in terms of our price growth. So this gives the actual numbers of the actual house price appreciation over time by geography. And over the course of the last year, house prices in Philadelphia County are up 14.5% from where they were 12 months ago. By contrast, across the region, they're only up 8%. And we even beat the US average. House prices nationally are up 12.6% on the year. So again, we still remain very low price, but our price appreciation has actually been above average compared to both our national and regional peers. Next. And we also, the one notable exception, however, is condos and apartments. There we actually remain the highest priced in the region, but that's primarily due to the very high density of our condo and co-op housing stock. Just this shows the median prices of condos and co-ops in the region back to 2000. Again, the red line is Philadelphia, green line of the suburbs, blue line is the US average. As you can see, the median price of a condo in Philadelphia is close to $300,000 compared to just $200,000 in the suburbs. But again, that's because our condo and co-op stock tends to be very high density, which is much more expensive to build than low density. If you're going to build 50 units of housing in a single tower versus 50 units of housing in garden apartments, I guarantee that the unit costs of those units in the high rise will be much more expensive than the low density garden apartments. So that's primarily driven by the very high density of our, and also upscale amenities of our condos in Center City. Next. Our higher density results in higher condo and apartment prices. Again, if I break that out by county across the region, again, the red line is Philadelphia. Again, you can see our condo and co-op prices pretty much surpass everything else in the region. Even the more affluent counties of Montgomery and Bucks and Chester, their condo prices are still lower than in the cities. Next. All right, so then looking at neighborhoods in the city, we have seen significant variation in price appreciation across neighborhoods. So here I divide the city up into roughly about 9 submarkets, and each one's color coded, for a different submarket. As you can see over time, neighborhood prices tend to track what the citywide average is. You can see they're up during the 2000s, during the housing bubble. You can see the decline during the Great Recession, and then you can see the expansion during the current cycle. But notice that the dispersion of those lines, or the spread between them, has increased significantly during the current expansionary cycle. Right now, University City in South Philly have been the biggest beneficiaries over the last 10 years, followed closely, believe it or not, by West Philly and North Philly, which in the last 2 years have really taken off. And I'll talk a little bit more about that in a minute. Next. In the last few years, North Philly and West Philly have actually seen the greatest appreciation. So North Philly right now is up 17.6% from a year ago. West Philly is up 20.5%. And even just over the past quarter, North Philly is up 4.9% and West Philly is up 6.5%. What are the reasons for that? There are 3 of them. One of them is that the geographic definitions of North Philly and West Philly are changing, because Center City is expanding into North Philly and University City is expanding into West Philly. So as that expansion occurs, in the sense that the housing stock is being occupied more by people who are working in Center City or working in University City, that's raising the average level of prices in what was traditionally parts of North Philly or West Philly. The second reason is that those markets have received a lot of federal funds in the wake of the social unrest that occurred in the summer of 2020. So those funds have been used to rehab a lot of storefronts that suffered damage, and upgrade streetscapes and things like that have increased the desirability of the neighborhoods. And then the last is the investment of institutional capital, particularly academic capital. But Temple University, University of Pennsylvania, and Drexel University have invested significantly in these neighborhoods, particularly in neighborhoods immediately surrounding the schools, not only in terms of improving housing and expanding, opportunities for student housing, but also improving the safety of the streets, lighting, streetscaping, and things like that. So all 3 of those forces have acted to significantly pump up average house prices in North Philly and West Philly. Next. Philadelphia has also improved its performance relative to other large U.S. cities. So we not only outperform the suburbs during the current cycle, we are actually outperforming or close to outperforming a lot of other large U.S. cities. So the red line here, again, is my house price index for Philadelphia, the same one I've been showing you. And the black line is Case-Shiller's house price index, composite house price index for the 10 largest U.S. cities. So it reflects house price appreciation in the 10 largest U.S. cities over time. Generally speaking, you can see the red line lags the black line. Historically speaking, we have lagged house price appreciation in most other large U.S. cities. We're not only lower priced than most other large U.S. cities, but our house price growth has been generally slower. But over the past few years, we've actually performed on par with them, and even in a few years, even outpaced them. And if we go to the next chart, I'll show you how. So the next chart shows the same as the previous, but instead of showing the level of the house price indices over time, I'm showing their year-on-year percent change. So here I'm showing the rate of return in house price growth in the 10 largest U.S. cities, which is the black line, and then Philadelphia, which is the red line. If you look all the way to the right, you notice that the red line is above the black line. During the current expansionary cycle, which is roughly 10 years old now, house prices in Philly have been growing on an average about 6 to 7% per year. But in the 10 largest U.S. cities, they were growing roughly about 4 to 5% per year. Now, over the last year or so, they've caught up. But again, if you just bought a random home in Philly 10 years ago and then made a portfolio of one home in each of those 10 cities, the Philadelphia home would have shown a greater rate of return than the homes in the other large U.S. cities. Again, they've caught up in the past year or so since COVID hit. But again, that's a pretty good performance considering that we've historically underperformed most other large U.S. housing markets. Next. So that's prices. Now we'll talk about home sales. So home sales remain high, but they are trending down. And this is not from the MLS. This is all from public records. So it covers the universe of all home sales in Philadelphia. Much like prices, home sales tend to be cyclical. In any given quarter, about 4,000 homes change hands in Philadelphia. You can see that during the peak of the 1980s, we're up to about 5,000 homes changing hands, and it declined during the recession of the early 90s. You see the big spike in the middle is the housing bubble years. Back in 2005, 2006, we had about 8,000 homes changing hands every quarter, double our historic rate. And then you see sales started to decline. And notice where they are now. So they're still running above average, but we appear to have hit our peak volume roughly around 2017 or 2018. So we still have strong sales, but again, they're trending down. And remember, sales tend to be a leading indicator of prices. That is, when there's a turning point in the housing market coming, sales tend to decline or start to increase before prices do. So you can see sales peaked back in 2005, 2006, but prices didn't start declining until 2007, 2008. Well, you can see where we are now. Again, sales still above average, but they are trending down. And again, I think that is a leading indicator that we may be hitting the peak of the current cycle. Next. The one thing that is not trending down is $1 million home sales. They continue to break records. So this shows $1 million home sales in Philadelphia over time. Historically, in any given quarter, we maybe have about 15 homes change hands at a price point of $1 million or more. And by the way, these are just houses. This does not include condos. These are just single family houses. Last quarter, it seems every quarter we break a new record. Last quarter, we broke another one. We had more than $50 million home sales across the city. And again, you have to go back prior to the year 2000. You'd be lucky to have $5 or $6 million home sales a quarter. And we're not building a whole lot of $1 million houses. Most of these represent the bidding up value of existing very nice houses in Center City and Northwest Philly, or the upgrading of that housing stock by investing and improving in them. That indicates that the location value of Philadelphia remains strong among relatively high income households, and that they're willing to pay a significant price premium to live here. Next. Of course, you want to know where the $1 million house sales are. So this map shows them. They are becoming less spatially concentrated. You'll notice that the highest concentration, of course, is in Center City, particularly around Rittenhouse Square and Washington Square. But if I showed you this map just 5 years ago, that's the only place you would see $1 million house sales, and occasionally one or two in Chestnut Hill, and every once in a while in Mount Airy. But they're coming significantly less spatially concentrated. I see $1 million house sales in University City, in Fairmount, even in Fishtown, Northern Liberties. Again, not a huge concentration, but again, more than 5 years ago, you never would have seen that. And now we are seeing more of them. So that represents a significant investment in revitalization outside of just our very core highest affluence neighborhoods of Rittenhouse Square and Washington Square. Next. Another interesting fact is that home sales in Philadelphia have become more biased towards higher priced homes. So I talked about the $1 million sales. The data sample of home sales in Philadelphia that occurs every quarter is not representative of house values across the city. I'm seeing disproportionately more sales occurring towards the middle and higher income segment of the market. So this chart gives some support to that. So the blue line is just the median house price in Philadelphia over time, and the red line is the house price index. And the first thing you'll notice about the median price is that it's very volatile. And that's because there's lots of noise in just raw house price numbers, as you well know. Seasonality is a big one. Prices always go up in the warm weather months and fall in the cold weather months. And then there's just a lot of what we call idiosyncratic noise. So, in one given period, homes in more affluent parts of the city sell, and maybe in another period, homes in the less affluent parts of the city sell. But one thing that I am seeing is that the home sales that are occurring are disproportionately starting to occur in the moderate and upper income segments of the market. And that's represented by the divergence of the blue line from the red line. The house price index that I compute, which is the red line, is done via regression, which basically controls for all the noise and seasonality. So it basically removes all that noise from the data. So what we have left is just the secular market-driven movements in house values across the city. You can see up until the peak of the housing bubble, the blue line and the red line tracked each other pretty closely. But since then, the blue line's been diverging from the red line, indicating that of the home sales that are occurring, the raw prices are higher than what the index is indicating, which strongly suggests that home sales are becoming skewed towards the upper end of the market, and we're seeing fewer and fewer transactions in the lower end of the market. Now, that doesn't mean they're not occurring, they still are. I'm just saying their percent of the share of all home sales is declining. And again, I think that goes to the affordability, increasing affordability issue that we're all facing. When house prices outpace income growth, it's lower income people that get hurt first because they get cut out of the market first, and lower interest rates generally aren't enough to offset that. Next. Excuse me. So inventories, I know this is, I'm sure, a pain point for all of you. I know it is for me and for pretty much everyone in the housing industry right now. Is inventories as listings are at all-time lows. This shows the number of houses listed for sale in Philadelphia versus the absorption rate. Inventories peaked in Philadelphia right at the peak of the housing bubble. Back in 2007, we had about 12,000 homes listed for sale, which is roughly double our historic average in any given month. Historically, Philly has about 6,000 homes listed for sale. Right now, we're down to about 3,000 and even lower in some sub-segments of the city. And because inventories are so low, the month supply is very low. That's what the next slide will show. So we remain very much in a deep seller's market. This shows the month supply of inventory in Philadelphia, which is how many months it would take to burn off the current number of homes listed for sale, given the current pace of sales. As you well know, in a typically balanced market, you have between about 5 and 7 months supply of inventory. Anything more than that, you're in a buyer's market. And right now, we're less than 2 months supply of inventory, meaning that if no one else listed a home for sale, and we just let the current inventory of homes burn off at the current pace of sales, we would have no homes left for sale after just 2 months. Okay, nothing. That's all we have is 2 months. So very much deep in a seller's market. And again, that's one of the other reasons we've seen such aggressive price appreciation, is because the supply has been so low. Next. We also know that houses are transacting at a very fast pace. This shows the average days on market for Philadelphia homes. Historically, average days on market is roughly, can be between 40 to 60 days. Some people say it should be around 30 days. During the Great Recession, we were about 80 to 90 days. We've been declining ever since. Right now, the raw data that I've gotten is indicating we are at an average time it takes to move a home is just over 30 days. But BrightMLS says it's even lower, and we can be as low as 11 to 15 days in some areas of Philadelphia. So supply is low, price growth has been aggressive, and the turnover rate has been, the velocity of sales has been very, very high as one of the results of supply being so low. Next. Home builders remain bullish on the market, but that is starting to soften as well. So the National Association of Home Builders publishes an index of home builder sentiment. Basically, they take a survey of all their members every month and ask them on a scale of 0 to 100, how optimistic or pessimistic are you feeling about the near-term outlook of your business? Anything over 50 means more builders are optimistic than pessimistic. Anything under 50 means more builders are pessimistic than optimistic. So the black line is the National Home Builder Sentiment Index. The blue line is just for home builders in the Northeast. That time series is not as long. So you can see where the index takes a big dip. You can see the recession of the early 90s. Then you see the Great Recession when the Home Builder Sentiment Index hit a low of 9. And since then, it's been growing aggressively. You can see it took a big dip during the spring of 2020 during COVID. Again, it plunged to a value of about 17, but a strong rebound since then. It hit an all-time high of 90 just a few months ago. But since then, they're starting to soften. So much like home sales, home builder sentiment is running above average. but it's starting to trend downwards. Next. A similar trend is also we've seen in housing stocks. So housing related stocks also remain strong, but that's also softening a bit too. So our own Philadelphia Stock Exchange actually has a housing sector index, which is composed of all publicly traded business that are directly associated with the U.S. housing construction market. So that includes mostly residential home builders, building suppliers of building supplies, mortgage insurers, things like that. You can see the big dip in COVID all the way there on the right. The strong rebound in housing stocks that's been commensurate with how well the housing market's been doing. But again, in the last few months, we've seen some softening in that index as well. Next. Building permits, this is one of my favorite slides right here, are at record levels, but don't read too much into it because it's primarily due to the incipient changes in the abatement. So this shows approved residential building permits in Philadelphia based upon the number of units over time. And you can see the big surge in building permits during the current expansionary cycle that began roughly around 2011. Right now, based upon all the permits that have been filed and approved by L&I, we are on track to add nearly 10,000 new housing units to our housing stock, which is an all-time record. Probably we have not seen a surge like that since the post-war construction boom. But again, don't read too much into it. That does not mean that 10,000 new housing units have broken ground or 10,000 new housing units have been completed. It just means that 10,000 new housing units have been approved. And the reason we've seen such a surge is, as many of you know, once the new year rolls over, the legislation that modifies our 10-year tax abatement will take effect, and it's basically going to cut the value of the abatement in half in terms of its value to house prices. So what we are seeing is a lot of builders this includes both rental and house sales units. So the green component is multifamily units, the purple component is single family units. So what we're seeing is that basically all the home builders in the city are trying to file to get their building permits approved before the new year rolls over, because once the permit's approved, you still have the full value of the abatement, even if you don't break ground or complete your unit in the future. So I would not expect 10,000 new units to be completed in the next year. Some of them I'm sure will never break ground. Some won't be done for 2, 3, 5 years. But again, the builders are rushing to get those permits approved before the changes the abatement take hold. Next slide. Here's another one of my favorite slides. It compares building permits in Philadelphia, which is the same chart I showed you on the previous slide, and that's on the left, to building permits in the suburbs. And there's really quite a contrast in both the patterns and trends in city versus suburban home building. So again, the green component of each bar represents the number of multifamily units that have been approved, and the purple component represents the number of single family units. So first of all, you see that construction in the city is overwhelmingly concentrated in multifamily units. These are apartments and condos, whereas it's overwhelmingly single family housing in the suburbs. Not a surprise there, the suburbs are just lower density. But also notice the difference in trends over time. First of all, overall home building volume in the suburbs is still substantially higher than the city. If you look at the vertical axes, you see that the axis for the suburban scale is much, much higher. So at any given year, the suburbs are adding, roughly 15,000 new housing units. Historically, we're lucky to add 3,000 or 4,000 new housing units to our housing stock. Now, the suburbs are a bigger market than us, but it's quite a contrast. But notice that the suburbs have actually been trending down. They hit their peak back in the mid-1980s when they were building about 30,000 new units per year. Then in the 90s and 2000s, they were building between 15 and 20,000 new units per year. And during the current expansionary cycle, which has been, again, one of the strongest, most aggressive rates of house price appreciation we've seen, they're only adding 10,000 new units per year. By contrast, we've hit the intersection point with them. We just approved 10,000 new housing units in the city, but that's an all-time high for us. But again, we seem to be trending upward in terms of new construction, whereas the suburbs seem to be trending downwards. Next slide. So that's the general metrics on the market. Now I want to talk about some of the underlying issues and analytics that are implied by those numbers. And one of the biggest ones is housing unaffordability. And that has risen significantly since COVID as prices of basic price growth has been outpacing income growth. So I'm going to measure affordability very simply. It's the ratio of the median house price in a given market to the median household income. So as you know, excuse me, generally speaking, you should be spending between 35 and 40% of your income on housing per year. So that's your rent plus or mortgage payment plus utilities, and if you own, it's also your maintenance cost plus your property tax payment. If you're spending more than 40 to 45% of your annual income on housing, that crowds out income you would be spending on other necessities like food and clothing. And so most economists would characterize that as an approaching affordability problem. So right now, our price to income ratio in Philadelphia is about 4.3. So prices are about 4.3 times income. So we are encroaching on, the threshold of having an unaffordability problem here. Our affordability ratio is actually an unaffordability ratio, is up 15% in just 2 years. And moreover, it's higher than the national average and higher than the suburbs. And again, even though our house prices are much lower than the suburbs, because our incomes are so much lower than the suburbs, that even just modest appreciation in house prices in the city puts us on the threshold of an affordability problem. Whereas the suburbs are sufficiently high income that even though they've experienced significant house price appreciation, they're nowhere near having an affordability problem, at least not on a regional level. House prices in the suburbs are at a 3.5 times multiple of household incomes, whereas we're close to having our house prices be 4.5 times a multiple of our local incomes. And that is going to be an issue of concern, not only economically in terms of what it will mean for the market. The more unaffordable houses are, the more less turnover you're going to see in houses, and of course that's not good for the industry. So it's not just not good economically, it's also not good socially, because markets with affordability problems often start to have significant other problems as well, both economically and socially. Next. If we compare it and break it out by suburban counties, again, here you really see the contrast. So again, the red line is the housing unaffordability ratio for Philadelphia. And then the blue lines are the Pennsylvania counties, the green lines are the New Jersey counties, the purple is Newcastle. Notice that historically speaking, we were roughly in the middle of the pack in terms of housing affordability. So again, even though we were low income, our house prices were modest enough that we didn't have an affordability problem. It was our price to income ratio was lower than particularly the Pennsylvania suburban counties. But now we are number one in the region in terms of housing unaffordability. Our prices relative to our incomes have a much bigger spread between them than we're seeing in any other counties in the region. And that's been the case basically since COVID hit, is when we led the pack here, which is not a race we want to be winning here. You don't want to be winning this race. Next. Also, history suggests between some of the other data I showed you that we are also nearing the peak of the current cycle. So this is my real house price index for Philadelphia. So I take my traditional house price index, which is the red line I've been showing you on previous charts, and then I deflate it by inflation. So if the house price index rises by, say, 5% in a given year, but inflation that year is 2%, then I subtract that 2% from the 5%, so my house price index only rises by 3%. So it shows what house prices are doing net of inflation. And as you can see, house prices, as the cliche goes, in the industry are very cyclical. They tend to evolve around a long-term trend. That's what the black line is. It's just a linear trend line that fits through the data. But you can see when it will start to revert back to that long-term trend. So at the peak of the cycle back in 1989, the index was 26% above its long-run average, then it began to revert back to the median. At the peak of the housing bubble in 2008, real house prices were 32% above their long-run average, and then of course they began to decline. And right now, house prices are 21% above their long-term average. So if we compare that to the previous cycles, we're not quite at 26% or 32%, but we're starting to get pretty close. And the history suggests once you hit that threshold, you're going to start to see some mean reversion, which is a statistically fancy way to say that house prices will start declining, or at least flattening out and letting incomes catch up. Next. All right, so here's the actual very latest numbers according to BrightMLS. They shared through October 2021. The median sales price is up just 5.3% from a year ago. That's still pretty good. Our historic rate of appreciation is about 4.5%. So house price appreciation is still running above average, but it's a significant deceleration from the previous quarter's year-on-year increase of 14.5%. So in the past 3 months, we've seen the year-on-year change in house prices drop from 14.5% to 5.3%. Again, sales volume also remains above average, but it continues to decline. Sales down from the MLS are down 11.5% from a year ago. Inventories continue to frustratingly drop, but they have dropped less in the city than in the suburbs. The number of new listings citywide was down 6.5% from a year ago, but it's down 12.6% in the suburbs from a year ago. Median days on market still remains low. Turnover rate is very high, but that's held steady at a median of 16 days from a year ago. And then lastly, showings are also dropping. They're down 13% from a year ago. And I think that it has to do with a combination of very low supply and a combination of what I'll call buyer exhaustion. They're tired of looking at homes that were not their first choice and then being bid out of them. And on top of that, they're seeing house prices growing at such an accelerated rate that is putting a lot of the homes beyond what they're able to afford, or at least are even willing to pay, even with very low interest rates. So I think we're seeing buyers become more hesitant. That's what the declining showings are indicating. Next. So what do the latest numbers tell us? Summing this up, price growth remains solid, but is decelerating. I think that decreased choice, that is low inventory, is increased unaffordability, are the main drivers of this. Homes are still selling very quickly, but I think they have to both show right and be priced right in order to move. Sales are declining. And again, I think restricted supply and increased unaffordability are the main culprits there. So, are we at or nearing the peak of the current cycle? I think we need a little more time and at least a few more months of data, especially in the next spring, before we can make that call. But both my empirical sense as well as my gut instinct says it's feeling like it. And lastly, if you want further convincing of that, Zillow is also becoming more bearish too. So next slide, I'll show you their forecast for Philadelphia. So again, the red line here is my Philadelphia house price index. And what I did is I took Zillow's forecast for the next year for Philadelphia, and I just tacked it on to the end of the line. That's the dashed line at the end. Right now, Zillow is forecasting house prices in Philadelphia to increase 6.5% over the next 12 months. So that's still above our historic average, but that's a downgrade from their previous forecast of 8.3%, which, by the way, is also a downgrade of the previous forecast of 6 months ago, which was roughly 11%. So again, Zillow remains relatively bullish on Philadelphia, but we're seeing deceleration in a lot of indicators, and we're seeing also a deceleration in optimism in a lot of the projections of the market and a lot of the sentiment surrounding the market. So that's my summary on the state of the market. If we go to the next slide, I would like now to talk about what we've seen and how the effects of COVID have affected a lot of household migration patterns across the region. So if we go to the next slide. So here's three questions I've been getting asked a lot ever since COVID hit. How has the COVID pandemic affected the location decisions of households? What's the likely economic impact of these location decisions? And what's the particular impact on the housing market? So here's how I went about trying to answer this. Next slide. So the U.S. Postal Service publishes change of address data. So anytime someone changes their address because they're moving, they file a change of address form. The Postal Service collects that, and then they actually make that data available to zip code level, and they make it available over time. So I was able to download this data from their website. And so I collected this data from January 2020 through July 2021. And for each zip code in the region, both the city and the suburbs, I know the number of households who moved out of each zip during that period, and I know the number of households who moved into each zip during that period. So then what I did is I wanted to see how migration patterns were correlated with various socioeconomic and demographic factors. So to each zip code, I merged on things like the total number of households, median household income in each zip, the median house value in each zip, as well as several other socioeconomic and demographic variables. Next slide. So first we'll look at what the raw numbers are. So this table gives the net changes in the number of households and the effect on household income and house prices. So the bottom line is that the city of Philadelphia experienced a net population loss during COVID, during the period of January 2020 through just July of this year. About 200,000 households moved out of the city, whereas 456,000 households moved out of the suburbs, but only 165,000 households moved into the city, whereas the suburbs gained 461,000 households. So that's a net change in the number of households of about 36,000 households that the city lost. A net change of loss of 36,000 households in the suburbs, but a net gain of about 4,400 households in the suburbs. In percent terms, that means the city lost about 5.9% of its household population, whereas the suburbs actually gained 0.3%. So one thing that not only did the suburbs gain on net while the city lost on net, but notice the difference in the two numbers. They don't match, meaning that a lot more people left the city than the suburbs, but they didn't all move to the suburbs. They left the region as a whole. And from what I heard from a number of people is that a lot of people that vacated the city during COVID went to their vacation home at the shore or the Poconos, and they've been telecommuting to work since then. So they didn't all relocate to the suburbs. They relocated to the region. Next slide. So let's look at where the losses are. So here I color code each zip code in the region by whether it experienced a net gain in households or a net loss. So red zip codes are ones that experience a net gain. Blue zip codes are zip codes that experience a net loss. And then the gray ones are where there were no significant change one way or the other. So there's not a completely pure or clear pattern here in the gains or losses geographically. But in general, you'll see that most of the losses are concentrated in the city. If we drill in on Philadelphia County by jumping to the next slide, Here's Philadelphia County. During the last roughly 2 years, only 2 zip codes in all of Philadelphia experienced a net gain in population. That's 19119, which is Mount Airy, and 19118, which is Chestnut Hill. Both are very leafy, relatively low density, affluent communities with private backyards, good quality of life, generally speaking, pretty safe. And during times of pandemic, that lifestyle can look more attractive than living in a high-rise condo or apartment in Center City. But every other zip code in Philadelphia lost population during COVID on net. Next slide. So then just to see how extreme those gains or losses were, I then created a more detailed color ramp. So here, the dark blue zip codes experienced a significant loss in households. Light blue zip codes only a modest loss in households. Gray is no change. Light red is a modest gain in households, and dark red is a significant gain in households. And again, you can see the biggest gainers tended to be relatively more rural zip codes. But again, the biggest losers, again, are in the city, and particularly the low mod income parts of the city, as well as Center City. So if we go to the next slide, you can see really here, again, basically the lower density areas of Philadelphia experienced either only modest losses or even gains, whereas generally low income or high density parts of the city are the areas that experienced the greatest losses. So again, you can really see here where the concentration was in the gains versus the losses. So during a time of pandemic, high density living is not the most appealing thing, and density appears to be one of the biggest drivers of households' decisions to relocate during COVID. Next. And then to really look at where how extreme some of the gains or losses were, I then extruded each zip code in 3D here by its gain or loss. So again, blue zip codes are the net losers, red zip codes are the net gainers. You can see in the suburbs, even though there were zip codes that had experienced a net loss, the really big losses were concentrated in the very high density or very low income areas of the city. So Center City, and even North Philly, West Philly, and even lower income inner ring suburbs like Darby, Upper Darby, and Eden. By the way, the zip code that experienced the greatest net loss during COVID, and this is the biggest net loss across the region, was 19103, which is Rittenhouse Square. Next slide. And again, if we look at the gainers, here I extrude the zip codes that gained in population, which are the ones in red, by who gained the most. And it generally tend to be more affluent suburbs, but ones that had sort of a small town center that were walkable and maybe had access to transit, things like that, as opposed to very rural zip codes that had very low density living. So people left the city for the suburbs, but even the suburbs, they generally seem to prefer sort of a township style living, if you will, rather than actual rural lifestyle. Next slide. So then I looked at where the changes in house prices were, and that was pretty unusual. So again, here now I'm color coding zip codes by how much the median house price changed during COVID from January 2020 through July of 2021. And here we saw an interesting pattern. So there were zip codes that experienced population loss, but significant house price gains. And that's sort of an unusual story because almost if a market is experiencing depopulation, you expect to see softening house prices, not increasing ones. But it's not what we saw. And I think that has a lot to do with a shift from people moving from renting to owning. So even though they might have lost population, they might on net, they were losing renters, but they might have gained a few homeowners. And that's what we're seeing in the difference in house prices versus population growth. So we zoom in, also interestingly enough, South Jersey, which is generally speaking, one of the softest markets and submarkets in the region, experienced some of the most aggressive house price growth during this period. Next slide. So again, zooming in on the city, you can see the spatial pattern of house price changes during COVID is much more mixed than population changes. And again, look at Chestnut Hill and Mount Airy in the northwest part of the city. Again, they were the only 2 zips that experienced population growth, but they experienced only modest house price growth. It was actually below the citywide average. So house price growth there was still good. It was 11 to 13% on the year. But again, that's less than the 17, 18% that the city experienced citywide. Next slide. So then I want to look at what were really the correlates here. So we see a pattern of people moving from the city to the suburbs and moving from high density neighborhoods to low density neighborhoods. But clearly there's more going on than that. Those maps are just a little too mixed. So there's got to be some other factors that are in play here. So what I did is I ran a series of regressions on each zip code's change in the number of households on the various characteristics of that zip. So here's the first scatter plot I'm going to show you. On the vertical axis, each blue dot represents a zip code in the region. And on the vertical axis, I've got the percent change in the number of that zip's household during COVID. And on the horizontal axis, I'm going to look at each zip's median household income. And here we see a very strong positive correlation, meaning that higher income zip codes experience greater population gains, lower income zip codes experience greater population losses, okay? So the migration pattern here wasn't just from high density to low density or from renting to owning. It was also from relatively lower income areas to relatively higher income areas. Now, that does not mean that people moved from low income areas to high income areas. What it means is that there was a filtering process. So people moved from very low income areas to relatively lower income areas. People in relatively lower income areas moved to middle income areas. People in middle income zip codes moved to modestly upper income zip codes, and people in modestly upper income zip codes moved to very high income zip codes. The R squared of this regression, which is what's indicated in that box, is about 34%, meaning out of 0 to 100%. Household income, zip level household income explained 34% of household migration patterns across the region. Let me repeat that. A zip code's household income level explained 34% of the patterns in household migration level during COVID. A very, very strong correlation, a very strong explanatory factor. Now we'll look at a few more. Next slide. So also, like I said, people weren't just moving from modestly lower income to modestly upper income. They were especially moving from modestly upper income to very high income zip codes. So here I ran the same regression on the percent change in the number of zips household on the vertical axis. And here on the horizontal axis, I've got the percent of each zip code's households that have an income greater than 100,000. And again, we see a pretty strong correlation here. The R squared is about 16, 17%. So particularly very high income zip codes attracted the most population during COVID. Next slide. Another modestly explanatory factor was the age of the zip code's populations. Here on the horizontal axis, I've got the percent of each zip's population that is age 65 or over. And again, we see a positive correlation here. Not as strong as income, but again, age seems to matter. It's indicating that during COVID, people moved from relatively youthful zip codes, if you will, to zip codes with a relatively older population. Here, the R squared is about 14%. So not as strong an explanatory factor as, say, density or income. But again, I think this may reflect demographic changes of the millennials getting older. So there's just an upward filtering of the population, to relative, the median age of zip codes is just rising. Next slide. Then I looked at the percent change in median house prices versus percent change in number of zips. And here the relationship is negative, which again is rather confounding. So in other words, zip codes that experience greater population losses experience greater house price gains. And zip codes that had relatively low population losses only experience modest house price gains. And I think that, again, that's counterintuitive. Again, you would think population growth and house price growth would track each other. But again, I think what we're seeing here is we saw a lot of shifting in households from renting to owning. And so they get subtracted from the total population, but they get added to the housing population. And so that's what drove a lot of the increases in house prices. Next slide. And I have a slide showing something to that effect. So then I looked at the degree of education in each zip code. And again, we see a modest positive correlation. So on the horizontal axis, I've got the percent of each zip's households that have a college or professional, meaning graduate degree. And then on the vertical axis, I've got the change in population in each zip. And then the dotted line is the regression line. Here we see a modest positive correlation, indicating that more educated zip codes attracted more households to them. And zip codes with relatively lower education levels experience greater population losses. Here we see an R squared about 7.5%. So not a super strong explanatory factor, but there still appears to be something to the story there. Next slide. Now here's the big one. Here we see, I've looked at the percent of each zip code's households that rent, and then compared that to population changes. And here again, we see a very strong negative correlation. So the more of a population in a neighborhood or zip code that rented, the more population loss they experience. The higher the rate of homeownership in a zip code, the greater the population gains it experiences. And again, I think that's representing something of a shift, particularly among the millennials, to become first-time home buyers. They were leaving their apartments and buying their first home. And I heard this anecdotally from a number of realtors as well, that during COVID, they were on lockdown, so they weren't going out and partying and spending money. So their savings were growing. Because their savings were growing, they were able to pay down their student debt. Because of that, their credit scores went up. And on top of that, they got their stimulus checks. And so, in the last year or so, they've been coming out of their apartments and also pairing up and getting married and buying their first home. So homeownership rate's a very strong explanatory draw of how household population moved around in the region during COVID. Next slide. One thing that surprised me was not a factor was housing affordability. So I looked in each zip code, I computed the percent of each zip code's households that were paying more than 35% of their income in rent. And then I, again, compared that to the household migration patterns, nothing there. So housing affordability was not a factor in moving decisions by households, at least not statistically. It was not a factor. Next slide. But again, another big one is density. So here I looked at the percent of each zip code's housing stock that had more than 4 units. So basically I'm measuring the housing density, if you will, of each zip code. Very, very strong negative correlation here. So basically zip codes that had very high density housing stock, that were disproportionately condos and apartment buildings, experienced the greatest population losses. Zip codes that had very low density housing stock, that is, were mostly single family detached housing, experienced the greatest population gains. And again, I think that has a lot to do with, during a time of pandemic, lower density living is much more appealing than high density living, not only for your health, but just for even personal recreation purposes. You'd rather, you have a private yard, you can go out and enjoy some outdoor space, whereas living in a condo, you don't exactly have that option. Next slide. All right, so summing up, what are the post-COVID trends in household migration? We saw the trends. Here's where households moved from. They moved from the city to the suburbs. Within the city, they moved from more central neighborhoods to less central neighborhoods. Both in the city and the suburbs, they generally move from lower income areas to higher income areas, and from middle income areas to very high income areas. They also generally move from younger areas to older areas, but that's a relatively weaker trend. From less educated areas to more educated areas, but again, that's a relatively weaker trend. A big one is from owner-occupied area, that's backwards. It should be from renters to owners. Curiously, housing affordability does not appear to be a factor. And they also move from high-density living, multifamily dwellings, to low-density single-family dwellings, and from renter-occupied areas to owner-occupied areas. So those are the shifts that we've seen in household migration during COVID. So next slide. Let's wrapping this up. 2 major caveats to these trends. First of all, I think many of these trends were accelerated by COVID, but were not necessarily caused by it. Particularly the demographic trend of millennials aging and becoming more wealthy, especially due to their stimulus payments. So I think COVID helped accelerate their movement to becoming homeowners, but I don't think it was the sole cause of it. But also, as the threat of COVID, whether perceived or real, has abated, many of these trends have softened, especially the desire for less density and/or an urban location. We've seen demand come back for those segments of the market. Next slide. So bottom line, my sense is that most of the COVID-driven trends in household migration are important to be aware of, but that they've largely petered out by now. And lastly, as for where the market overall is going, next slide. Right now, I think the market's in a classical 3-way standoff, where the future direction of both prices and sales are headed will be determined by which 3 forces will have to resolve their conflict. Right now, we've got very low inventories, which is putting upward pressure on house prices. But we've got increased unaffordability, which is putting downward pressure on house prices, or at least it's reducing demand. And then we got the overall effect of inflation in the economy, and that's got mixed effects on house prices. You might think in general inflation would cause house prices to go up, and yes, it can, but very high inflation also makes investors and lenders very risk averse, and the lenders become much less willing to lend. Buyers become much less willing to buy. They want to delay big purchases until the economy becomes more stable. So how inflation will affect things is the wild card. My own sense is that right now, I think decreased housing affordability is dominating, which is why we're seeing sales decline. I don't think interest rates are going to remain low enough to offset that. Inventories are the wild card. When they're going to come back up is anyone's guess. So, but that's definitely something that we're going to keep an eye on. So with that, next slide. Thank you very much. And if you have any questions, I'd be happy to answer them. And you can also, if you have any comments, or criticism or anything, there's my email address, kevin.c.gillen@drexel.edu. We love to get feedback on this. So thank you very much. All right, so we have a question: why are construction costs so much higher? In general, it has to do with our cost of labor. Basically, we're a union town. Land availability is part of it, but that affects the overall development cost, but not construction costs. Construction costs are basically materials costs and labor costs. Material costs tend to be material prices tend to be set at a national level. They really don't vary much from one location to the other. There can be some modest variation, like in the South, sheetrock is cheaper because gypsum comes from gypsum mines in the South, and in the northern Midwest and Northwest, lumber tends to be cheaper because that's where lumber is harvested. But the real cost of construction is our labor. I don't want to get in any political trouble here, but we are a union town. Generally speaking, if you give you a hard number, the premium of union labor over non-union labor is about 30%. So all else being equal, if you're going to build a home with union labor versus non-union labor, your costs are going to be about 30% higher. Now they'll tell you, union work rules, union work sites tend to be safer and they have lower accident rates, things like that. But the plain fact is they are more expensive.
Stephanie, any questions from you for Kevin?
Yes. Good morning, Dr. Gillen. Quick question. So prior to the pandemic, there was a trend of suburbanites moving into the city. And obviously, everything being shut down, their motivation was the lifestyle, the entertainment, the restaurants. Now that things are starting to open up, do you see that trend picking back up? It's a seller's market right now, with homes being on the market less. Who do you know where those buyers are coming from, and are they the suburbanites moving into the city?
We've seen, I haven't so much seen suburbanites moving into the city as I've seen people who left their condo during COVID moving back in. I've heard and seen, more of that. The condo market still remains sort of this relative soft spot of our housing market. Where a lot of those condo buyers are very affluent older people, and they're the ones that are most, have the greatest risk exposure to COVID because they're older. On top of that, as you pointed out, if restaurants aren't in capacity and you're not going to the museum or the theater, I mean, that takes away one of the main reasons to live in Center City, right? Is the lifestyle. I mean, the incredible options of amenities or entertainment and dining and shopping. So they are still appear to be a little more reluctant, but again, they're not fleeing like they were 18 months ago, which it really saw some real softening of the market. So I would say that segment of the market may not have rebounded, but it has stabilized.
Thank you.
So Kevin, I have a quick question for you, and this relates to City Hall. What do you think could happen?
Turn the recording off.
Okay. Is there some sort of policy thing that could be happening to make this situation a little bit better in our industry?
How much time do we have left? I was amazed. You had Mayor Kenney on one of your coffee talks, like, what was it, 2 weeks ago or so?
Mm-hmm.
And his comments on the abatement blew me away. He actually said that, I recall, he regrets the changes that they made. I was flabbergasted by that. I think that's, I was very much against it. People think the abatement is what causes gentrification and, disproportionate amount of our new construction being driven to the high end of the market. No, it's our high cost of construction that causes that. The abatement is the Band-Aid to that problem. Okay, it may not be the solution, but it was a Band-Aid. So basically, you have a high cost of development, but then the abatement, basically because it lowered taxes on the property, it increased property value. So that helps cover that high cost of construction. Now they cut that abatement in half. They've taken that away. Okay, they've taken that away. And the fact that you see, I think the numbers substantiate my position, because if the abatement weren't that valuable, if the changes to the abatement didn't mean that much, why are home builders stampeding L&I to file for building permits? Why are we saying that? Are you telling me that they're all wrong? No. So I agree with Mayor Kenney, but I was flabbergasted that he said that. But in a sense, I understand why they felt pressure to make changes. I speak to community groups as well as industry groups, and there's a lot of sentiment out there that, home builders are causing displacement, they're causing gentrification, they're causing housing unaffordability. And the abatement is, this unnecessary subsidy to them that they don't need. So I don't think that the changes that council and the mayor made to the abatement were arbitrary. The political pressure that they were under to make those changes is very, very real. But I still disagree with the changes. But again, you want to blame public officials, but at some point, if they're under pressure from the public, then that's who they're answering to, right? So I could blame a miseducation of the public, the broader public on this issue as much as I make criticisms of our elected officials.
All right, well said and very diplomatic. Well played. And we actually kept that on the recording. So with that, I think we're ready to wrap it up. Kevin, thank you so much for your time, your research, your presentation today. Super, super helpful information, high quality content. Want to say thank you again to BrightMLS and to the Pennsylvania Association of Realtors for their sponsorship of today's general membership meeting. Tremendous turnout. I know we had lots of people dipping in and out today because it was a long session. But it was great to see so many of our folks jump in here for either a long haul or for a few minutes. And again, thank you to all of you. We'll see you on the next one. And Stephanie, I think we're gonna squeak out one more coffee talk before you exit out the side door. So
Okay.
no,
No
I think
Irish
there's
exit.
good to the last drop, as they say, right? So with that, everyone, have a great day. Take care. Bye.
Thanks, guys.
Thanks.
Thanks, Matt. Bye now.
Thank you.